So if your investment radar is tuned for high income, you probably stumbled across MREITs, right? Mortgage Real Estate Investment Trusts.
Oh, absolutely, that alphabet soup.
Exactly. And you see the big one, AGNC Investment Corp.
Mm.
Always flashing these historically high dividends, paid out frequently.
It looks incredibly tempting on the surface, that income stream.
It really does. But, you gotta look under the hood.
Hmm?
So our mission today, a deep dive. Let's try and strip away the jargon.
Okay.
We need to figure out what AGNC actually does, how they cook up that yield, and crucially, what are the big trade-offs you're making for that income?
Right. Let's start with the basics. What is AGNC? It's an internally managed MREIT. And their main thing, almost all they do, is invest in agency residential mortgage-backed securities. Agency MBS for short.
Agency MBS.
Okay. And the key thing, the absolute differentiator here, is that the principal and interest, they're guaranteed against credit losses.
Guaranteed by who?
By a U.S. government-sponsored enterprise, think Fannie Mae, Freddie Mac, or even a government agency like Ginnie Mae.
Okay, so right off the bat, we know they use a ton of leverage, but the actual assets they hold, they're essentially government-backed.
Pretty much, yeah.
So the risk of borrowers just not paying, the credit risk, that's basically zero or close to it.
It's neutralized, essentially.
Yeah.
Which sounds great, almost too safe.
Huh. Yeah, that tells me the real risk is hiding somewhere else.
Precisely. That guarantee gives them a huge leg up market-wise, but risk is definitely still there. It's just shifted, more operational, more market-driven.
Okay, let's unpack that. If the credit risk is gone, how on earth do they generate those yields? We're talking double, sometimes triple what a normal bond pays.
Yeah, it boils down to a classic financial play, basically a carry trade, but amplified massively with leverage.
Little carry trade.
Okay, so AGNC's core job is buying long-term agency MBS. These assets pay a fixed interest rate over, say, 30 years.
Right.
And they fund those purchases by borrowing short-term money, usually at a much lower variable interest rate.
Okay. And the difference between what they earn on the long-term mortgage bonds and what they pay on the short-term loans, that's the profit margin.
That's the net interest spread, exactly. But here's the catch. For super safe assets like agency MBS, that spread, it's usually razor thin.
Okay, so how do they get a double-digit return for shareholders from a tiny spread?
Leverage. Massive leverage. Think about it like this. For every, say, $10 of their own capital, they might borrow $90 or even more.
$90 borrowed for every 10 of their own. Wow. Okay, how do they borrow that much? What's the mechanism?
Yep.
Our sources mention repurchase agreements a lot. Repos.
Yep, repos are the main engine here.
Can you walk us through what a repo actually is and, why relying on them might be dangerous?
Sure. A repurchase agreement is basically a very short-term loan, often just overnight or maybe for a few weeks.
Okay.
AGNC, the borrower, sells some of their agency MBS to a counterparty like a big bank, but they agree up front to buy them back very soon at a slightly higher price.
And that price difference is the interest on the loan.
Exactly. But the danger is, well, it's twofold. And it comes down to this mismatch in timing, the duration mismatch.
Mismatch.
Yeah. First, they're funding stable long-term assets, those 30-year mortgages, with highly volatile short-term money like overnight repos. So if short-term rates suddenly spike, their funding cost jumps instantly. That can crush their net interest spread overnight.
Ouch. Okay. And the second danger?
The second is collateral value. If the market value of those agency MBS they're using as collateral starts to fall, maybe because overall rates are rising, their lenders can get nervous.
What happens then?
They can demand more collateral immediately, a margin call. Or worse, they might just refuse to roll over the repo loan when it comes due.
Forcing AGNC to sell assets potentially at a loss just to pay back the short-term loan.
Precisely. That's where the fragility really lies. It's a system built on continuous, cheap, short-term funding.
But let's not forget why they do this, the dividend mandate, right? Why are they almost forced into this high-wire act?
It's baked into the MREIT structure itself. To keep that special tax status being a real estate investment trust and avoiding corporate income tax, AGNC is legally required to distribute at least 90% of its taxable income to shareholders every year.
90%, so they can't just reinvest their profits easily.
Nope. They have to push that income out to you, the shareholder. That legal requirement is why the payout is so high and why they historically pay it monthly.
Right, okay. So the mandate forces them to maximize income, and the only way to get big income from low-yield, safe assets is massive leverage.
You got it. And that leads us straight into the risks they have to juggle constantly.
What are the main ones?
The big two are interest rate risk and prepayment risk. And they try to manage these using dynamic risk management, hedging, basically.
Hedging, you mean like using derivatives?
Exactly. Things
Yeah.
like interest rate swaps, futures contracts. They're essentially placing side bets designed to pay off if interest rates move against them. The goal is always to protect that net interest spread.
Okay, sounds complex. Let's flip the coin now. Let's talk about the appeal. Why do people gravitate towards AGNC, especially income seekers?
Well, the first one's obvious.
The high dividend yield.
Yeah.
It's consistently up there, and like you said, it's driven by that 90% payout rule.
Right. And for many investors, that translates into really predictable cash flow, especially because AGNC pays monthly.
That's a big deal for some people, right?
Yeah.
Managing household budgets, living off investments,
Mm.
monthly cash is way easier than quarterly.
Definitely an operational advantage. And then there's the safety aspect of the assets themselves.
The low credit risk.
Because it's agency MBS, that guarantee from Fannie, Freddie, Ginnie, it just takes away the worry about borrowers defaulting in huge numbers, which can happen with non-agency MREITs.
Good point.
And there's one more operational plus, liquidity. Agency MBS are traded constantly, huge market, very liquid.
Why does that matter so much?
It gives AGNC flexibility. Remember, they have to constantly adjust their hedges, maybe tweak their asset mix if the market shifts.
Because the Fed did something or the bond market went haywire?
Exactly. High liquidity means they can make those moves fast when they need to. It's critical for managing that volatile spread.
Okay. Now for the really interesting part. The trade-offs. The volatility. We've established the assets have low credit risk thanks to the government backing. So the risk has to be somewhere else. What's the single biggest threat?
No question. Extreme high interest rate sensitivity. This is the Achilles heel of the whole model.
Explain that. How does it work?
Okay, think about their funding cost. There's short-term repos. When the Federal Reserve hikes the Fed funds rate, or just when market short-term rates jump.
Their borrowing cost goes up instantly. Yeah.
And that directly shrinks the net interest spread, potentially very fast. If their borrowing costs rise faster than the interest they're earning on their older long-term bonds, profitability just vanishes.
Well, we've seen that happen, haven't we? That sensitivity pops up immediately in a key number investors watch, right? Book value volatility.
Exactly. Book value per share, the company's net asset value, is tied directly to the value of their bond portfolio.
And bond values move inversely to interest rates.
Correct. So, simple example. If you own a bond paying 3%, and suddenly new bonds are being issued paying 5% because rates went up.
Your old 3% bond isn't worth as much anymore. Nobody wants it unless the price drops.
Right. Now imagine AGNC holding billions of dollars worth of these fixed-rate bonds when rates shoot up quickly like they did through most of 2022.
The market value of their entire portfolio takes a nosedive.
A nosedive. And that directly slashes the company's book value per share. It's not theoretical. We saw this crush book values during the 2013 taper tantrum and again in the recent hiking cycle.
So the stock price often swings wildly because it's trying to follow this bouncing book value, which is basically just reacting to Fed announcements and bond market jitters.
It's dancing to the Fed's tune, absolutely. Which brings us back to the risk multiplier.
Leverage risk.
Yep. Leverage is great when the spread is working for you. It juices the returns, but it's brutal on the downside.
It amplifies losses just as much.
Even more, sometimes. If that portfolio value drops because of rising rates, the losses get multiplied because of all the debt they're carrying. It can trigger those margin calls we talked about, forced asset sales. It gets ugly fast.
So the basic idea seems simple. Borrow low, lend high, but actually doing it sounds incredibly complex.
Oh, it is. They're constantly juggling interest rate duration, managing leverage levels, paying for complex hedges. Just to try and keep that spread stable. It's a full-time battle.
And all that complexity and volatility leads to the dividend reality check.
Yeah, that high yield. It feels great when it's coming in, but it is not guaranteed, not the amount anyway.
So investors banking on a perfectly steady income stream need to be careful.
Absolutely. If rising rates kill the spread, or if book value tanks, the company's taxable income drops. And if income drops, that dividend payout has been cut in the past, and it can be cut again. It just follows the market conditions.
So not as stable as it looks sometimes.
Definitely not rock-solid fixed income. Okay, 2 final drawbacks we really need to hammer home.
Go for it.
First, complexity. This business model, yield curves, leverage, swaps, hedging, It's just fundamentally harder for an average investor to really understand and analyze compared to, say, a company selling
They
widgets.
need to do way more homework.
A lot more due diligence, yes. Second, and this is key, there's basically no capital appreciation focus here.
Meaning the stock price itself isn't really expected to go up much over the long term.
Pretty much. Remember, they have to pay out almost all their earnings. They can't retain much to reinvest and grow the actual equity base of the company.
So the stock price bounces around, sometimes violently, but over long stretches, it often just drifts sideways or even down.
That's the historical pattern. It acts more like a managed, leveraged bond substitute than a typical growth stock. You're there for the income, not the share price growth.
Wow. So let's tie this all together. What does this mean for you, the listener? We've hit a lot of points, especially the trade-offs.
Yeah, the core conflict seems really clear now, doesn't it?
I think so. That huge dividend from AGNC. It's a direct result of this very specific model. High leverage, low credit risk, but super high interest rate risk.
It's a fundamental trade-off. You're essentially swapping capital stability for potentially high, but definitely volatile income.
Yeah, volatile income flow versus capital value volatility.
And what's really fascinating, stepping back a bit, is how AGNC's health has almost nothing to do with homeowners paying their mortgages on time.
Right. It's not about the microeconomy of housing.
No, it's almost entirely about the macro picture. What's the Federal Reserve doing? What's the bond market doing? It just shows how deeply monetary policy ripples through the system and hits your returns, even on supposedly guaranteed securities.
So the big takeaway, with the standard disclaimer that this isn't investment advice,
Of course.
is that getting that extra high yield almost always means taking on extra complexity and extra volatility somewhere else.
Yeah.
Here, you're trading the devil you know credit risk for the devil you might not know as well, interest rate risk.
And then you're multiplying that rate risk with leverage. It's a potent mix.
Definitely requires eyes wide open.
So maybe a final thought for you to chew on. AGNC relies heavily on those complex hedging strategies to survive interest rate swings.
Right? The swaps and futures and things.
Okay, so given how sensitive book value is to rising rates, how truly effective can those hedges be? Can they really neutralize that massive interest rate risk across a whole economic cycle, especially when the Fed does something unexpected?
That's a tough question. Can this shield always hold up against the storm?
That uncertainty about hedging effectiveness, that's really the core of the ongoing due diligence you need to do with an investment like
A
this.
really crucial point. Well, we hope this deep dive has shed some light on AGNC. As always, please do your own thorough research, or better yet, talk to a qualified financial professional before diving into complex, high-sensitivity investments like these.